Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Well, let's look at the other side of this trade. Let's go naked on this trade. Now, what I think is funny is I often talk with my wife when I get home. It's ironic that I can have it be perfectly socially acceptable in the line of work with which I'm in, to where I can go home and she'll say, well, honey, what did you talk about today? And I can say, well, I talked about doing some naked straddles with people. And I just always think that's funny with the names that come out within the option trading world. Now, with that being said, let's do a short straddle at this point. Short straddle is when we are also going to sell an at-the-money call and an at-the-money put. And with that, we will address the long strangle in and out of the money profit potential, so to speak. So in this case, we are selling an at-the-money call and an at-the-money put. With that being said, when we're selling naked options like this, we're selling an at-the-money call and an at-the-money put. This is premium central right here. We are going to get a lot of juice for this premium right here on the spot. There's no strategy that's going to give you a greater amount of premium as a neutral strategy per contract than the short straddle. However, what's the disadvantage? Well, here's the disadvantage of it. Naked unlimited risk. Now, naked means naked, folks. If the market goes higher, it's as if you're short the underlying as high as it goes. You're going to consistently lose. You have unlimited risk. Unlimited risk means unlimited. And for the people that were short straddles or strangles on the euro, with that, what's the likelihood of the euro moving as many points as it did? That's probably what people said before Greece. Well, with that, well, as someone put in the audience, they did get killed. I always have a saying that I always tell people, never fear the market, but always respect the market. I'm not against selling naked options. However, when I'm selling naked options for clients or for my own account, I watch them constantly. I have the streaming quotes on the entire time. I have my risk management put in place. I have the constant fear that the market's going to move and move a lot. If you're a beginning trader, I strongly recommend staying away from naked options at first, or doing them with very small amounts of money if you've never done them before. So with that being said, you need to respect the fact that something like what happened to the euro recently can happen to you when you're selling options. Now, if you're selling naked calls on the euro, well, then that's a different thing. But with that being said, if you're selling naked puts, obviously you got hurt, and you got hurt pretty badly. So what's the benefit of it? I just did my little scare tactic, and hopefully not everyone's scared away from the short straddle as of yet. What's the benefit of it? Well, this is an example, and we can look at some real-life examples at the end of this presentation today. You can see that on here we're taking in about $5 in actual premium for this. So that means that if the market, in this case it's the yen, YUK, it would need to move over 5% between the day that this screenshot was made and expiration for you to start losing money. You have a nice little potential profit range here as it goes. So this is the type of strategy that you would use when you're more neutral and that it doesn't move. Well, Mike, you know what? I'm just a little bit too scared of that. I want a bigger potential profit zone, so to speak. And you know what? If I don't get that exact profit, or I don't have that exact same profit potential on the straddle, I'm fine with that. I just want to make a smaller amount of money because I want to be a little bit more conservative if I'm selling naked options. Well, if that's you, allow me to introduce the strangle. Short strangle is when you sell a call and a put on the same underlying with different strike prices, usually both of them out of the money at the same expiration. So in this case, you can see from the older chart that we have, the underlying's trading at around 91. In this case, we're selling the 95 and the 88 call and put, respectively. So on that note, we have the difference between the underlying strike prices, meaning if it stays between 95 and 88, we're going to make our maximum profit. So it can go up, down, or stay the same, so long as it's between those 2 points at expiration, it's mathematically impossible for us to lose money if we hold till expiration. Now, with that being said, what if it goes in the money a little bit? What if it goes even a little bit above that strike price? Well, remember, it's only possible to lose on one side of this. That's the other benefit of the straddle and the strangle. You're only going to lose. You're going to be successful on 50% of the trade of the straddle or strangle, at least mathematically guaranteed. Now, that really sounds good, but let me tell you, that's only a half-truth I just told you. Let me tell you the rest of it. If the underlying goes to 1,000,000, let's say, that short put expires worthless, and you made money on half of the trade. However, you got killed on the naked call option side of it. When using a short strangle, you need to respect the market in the same way that you do as with doing a short straddle. It's less risk in terms of how far it can hurt you. However, both options are naked. And for those of you that were short options or naked options on the euro in the wrong direction, that's pretty much the only evidence that I think I need to say as to what can possibly happen. Now, once again, why would you do the straddle or the strangle? Once again, conceptually, this is the same trade, meaning you're looking for either a lot of movement or you're looking for no movement. To go through this, though, there's 3 reasons as to why you would consider doing a straddle or a strangle. It's not just if you're looking for movement, looking for no movement. There's other reasons that go along with it, and I want to get into the nitty-gritty of the straddle and the strangle because I'm hoping that everybody walks away today with with an enhanced version of the straddle and the strangle themselves. Let's examine them. First off, delta. First reason why people look to the straddle is that they're looking for a big movement in the underlying. They're not quite sure which way it's going to go, but they're looking for a real big movement. They think it's either going to go way up or way down, and there's various chart patterns that give them that signal to where you're not quite sure where the breakout's going to come, but you know there's going to be a breakout one way or another. So with that being said, let's see if we can take advantage of it. Let's buy a call and a put. And that way, if the underlying moves a lot, you make money on the call, or the put, you just don't know which one. This is typically how beginners trade straddles when they're first learning. And with that, the beginning trader is also going to want to figure out like where would be the best time to take advantage or make money off of the underlying moving enough. Well, typically the way with which we've often worked with people in doing it, when you can get a 50% profit, that's kind of where we tell people to start looking to get out of a straddle, so to speak. And this is in the speculative trading section of your account, when you're looking to make higher returns but take on higher risks. And obviously, we strongly recommend doing that with a smaller portion of your money. Now, the other reason why you would consider doing a straddle, and of course the disadvantage of doing a long straddle, premium risk is twice as much, meaning that not only do you have the call option working against you, you also have the put option working against you. Every day, no matter what you do, time decay is working against you. Time is not on your side, so you're doubling the time decay risk when doing a long straddle. Another disadvantage, it's not on the screen, but I'll tell you about it, is implied volatility risk. If the implied volatility of an option goes lower, then if all other factors remain constant, the value of the option itself goes lower. And we'll talk a little bit more about implied volatility in a little bit.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.